Ever pondered why some traders, despite having accurate market forecasts, fail to make a profit in the long run? The answer lies in the art of money management in Forex trading. In the world of Forex, money management is not about how much you spend on a shopping spree. It's about how you manage your trading capital, how much you invest in each trade, and how much you expect to gain compared to what you're risking. Let's talk about the two pillars of money management: position sizing and expectancy. Position sizing is about the size of your trade. Here's a tip: it's wise not to risk more than 1 to 2% per trade. Then comes expectancy, your expected gain versus your potential loss. The rule of thumb is to maintain a positive expectancy. Say you enter a position expecting a 50 pips profit, risking only 15 pips. This is positive expectancy. It means you can be wrong thrice consecutively and still turn a profit on the fourth attempt. Now, how do you implement these strategies? One effective way is through stop-loss orders. These nifty tools automatically close a losing position, preventing further damage to your trading capital. It's like an insurance policy against unforeseen events that could cause major losses. The next powerful tool in your arsenal is a limit order. It automatically seals a profit once the currency pair reaches a predetermined level. It's like having an autopilot for your trades, ensuring your winning position doesn't unexpectedly turn into a losing one. Now remember the golden rule of trading: cut your losses short, let your winners run. It sounds simple, but many traders do the exact opposite, which leads to long-term losses. One of the easiest ways to implement this rule is by using a trailing stop. This tool is a blend of a limit order and a stop order. If the market moves favorably, the trailing stop order moves with it. If the market turns against you, the trailing stop order halts, preserving your profits. So, in conclusion, successful Forex trading is not just about accurate market forecasts. It's about smart money management, knowing how much to invest, how much to risk, and when to exit a trade. It's about using the right tools like stop-loss orders, limit orders, and trailing stops. And most importantly, it's about cutting losses short and letting winners run. Remember, it's not just about making money, it's about keeping it too.